All right, guys. I'm Big Mike, and like always, I'd like to thank you for being here today. Today we have FuturesTrader71 back on BMT. I think this is his fourth or maybe the fifth time he's done a presentation. And this time I asked FT71 just to do a little something different. Instead of having a formal presentation, I instead asked him if he would just do like an open discussion, just an open Q&A. And so that's what we're going to do. Now, I apologize in advance. I'm pretty sick right now, and if I start coughing, then I'm going to have to mute myself, and you'll have to give me just a second while I'm dealing with that. But the general idea is that we're going to open up for questions from everybody in the room. So as you guys have questions, just type them into the box, and I'll try to get those organized, the best I can and present them to FT so we can try to talk about similar topics at the same time and not jump around too much. But I think some general high-level topics that we'll probably discuss today include market profile and just general option theory from a methodology standpoint, trading psychology and discipline. Those are always big ones. Risk and trade management, and probably also talk a little bit about actual timing of the trade itself and what FT refers to as stalking the trade, just looking at levels on your DOM, looking for absorption, those types of things. Excuse me. So I'm going to turn things over to FT. He can share his screen, so as he's explaining things, maybe he can visualize them as well. Go ahead, guys, and start asking the questions. I also want to remind everybody that the webinar is being recorded, and we will post the recording sometime tomorrow. And I will send a link out to FT once that's done, and he can also send it out to his followers. All right, guys, here comes FT71.
Hello, everyone. Thanks for having me on. Let me turn off my news feed here. I appreciate the invite, and I always appreciate coming in and chatting. Let me turn on my screen here in 1 second. Got so much stuff going on my screens. All right. So, again, thanks for having me on. We can start wherever you like. I guess folks want to ask any question. Yeah. I want to start off by just making it clear that really, for those who don't know me, my background is in professional electronic trading. I'm a member of the exchanges, but I never really traded on the floor. I have access. I have a jacket and a badge and all that stuff, and I used to use it to get motivated. I got membership mainly to reduce my costs, which is something that very few people know about, or relatively few people know about. And my point of view is not that of an educator or someone who's going to try to sell you on some sort of a product, although I'm a partner in a brokerage and that is actually going through a rebranding transition. We're waiting for NFA approval, but we do have, I am, a registered broker and so forth now. My point of view really is of a prop trader and a prop shop owner. I've been through a lot of people who went from not knowing what a futures contract is to being sustainable in this business. I've seen a lot of people, not that I backed, but others who come in and are a bit of a flash in the pan, just come in and fight the market, fight themselves, and go away real quick. And my involvement with the online community, social media, Twitter, Big Mike, is really stemming from my desire to change that paradigm, and I have a vision that we can help folks. We can't guarantee it, but we can help folks avoid the big pitfalls, and it's the big pitfalls that catch people. Silly things like coming in tired, upset, whatever the reason, and just imposing your will on the market without any control whatsoever on risk. So the themes that you're going to hear a lot, although I can sit here and talk about market profile until I'm blue in the face, the themes that I'm going to hit on and that you're going to hear about a lot are leverage, which is directly tied to risk control, and personality, psychology, behavior modification, habit forming, habit destruction, things like that. These to me are the keys to making it, or just, again, being a flash in the pan type thing. I'm assuming that with the folks that are in here, and there's quite a few of you in here, I'm assuming that you're here not because you like to gamble, not because you're bored, not because you don't have anything better to do with your Thursday evening or afternoon, depending on where you are, or Friday morning for that matter. You're here because you're trying to deal with some aspect of your trading, or enhance some aspect of your trading that you hope to get some ideas out of it. I'm going to do my best to try to provide that.
Well, thank you very much, FT, for that. And if any of you guys have not watched the webinars that he's done already on BMT, I definitely recommend checking those out. And you can also hit up some more webinars directly on his website at FuturesTrader71.com. Okay, guys, let's jump right into it while my voice is holding out, and let's get into the questions. LV asks, yesterday, FT, I'm assuming he's talking about Twitter, you asked how many setups traders usually have on a given day. LV wants to know, what was your answer to that same question? How many setups do you get each day?
Okay, that's a good question. For me, I'm trading in different modes, and I only tweet about what's popular, and that is the ES. For me, the ES, I trade the ES much different than what I trade other products. I generally like thinner, faster, more volatile, and therefore more risky products. Like, my favorite is the Eurex DAX futures, the FDAX. I don't recommend that anybody trades it who doesn't have a fairly sizable account and who doesn't already have some consistency or at least some really good risk controls. That's a product. I did a study and shared it with our traders in our brokerage room that compared the per contract volatility of various products, the NASDAQ, the ES, and then I did the DAX and the Russell. And the DAX comes out at about 5 times the bang per contract relative to the ES. The DAX also has a $16,000 exchange margin requirement per contract, and the margin requirement is a reflection of that risk and volatility. So in a DAX and Russell and these kinds of products, I used to trade crude oil a fair amount, 60 and so forth. I don't trade those as much.
Right.
I do a lot of scalping. But in the ES, which is where I'm focused when I speak publicly about trading, I'm looking at generally 5 setups, give or take. Days like today, you know, where the range expands. One second. Where the range has expanded a little bit, I could generate probably something like 6 to 8 setups. And by setups, I don't mean, you know, it's trending up, I'm going to buy the next pullback. That's not a setup. Although you might trade that way, I don't consider that a setup. That's just a trade. A setup is when you have a statistical edge, something that I've run through, and for my purposes, I've run through Excel and have tested and think has some statistical edge. I'll give you one, for example. One that I've tweeted about, the overnight high and the low. By overnight, I mean anything after 4:15 Eastern all the way to 9:30 a.m. the next morning Eastern. That's what I consider overnight in the ES. The high or the low, the high or the low, okay, it's important to recognize that it's an or, is broken in the ES 96% of the time during the day session. So the ES will test the high or the low 96% of the time. This is something that I had observed just from experience, but then a follower, I think his name was Mindflow or something, I know him by his real name, pointed that out to me, and then I decided, hey, I've never done that stat. And this was maybe a year ago or a year and a half ago. I ran a stat, and much to my surprise, he was perfectly right. It is about 96%.
I think
the probability. Go ahead.
Sorry, we have a thread on BMT for master statistics thread, and I think someone in there also proved the same thing to be true using up-to-date data. Like as of a couple months ago, it's still true.
Yeah, I check it every once in a while. It's a very simple study to do. And using the charting software that I have, it's a very simple study to do, and I update it every once in a while, unless I and I'll stick with that statistic. If it drops to 93.2 or goes up to 98.2, I don't really care. It doesn't make a difference to me. The fact is, it's a very, very high probability. But I also know that the market will break the high and the low 27% of the time. So there's a 73% probability that once it breaks one end, it won't break the other. That's a statistical edge.
Right.
Most trading systems can't get that high an edge.
Right.
Okay. So that's what I consider a setup. Setups that form off of the initial balance, which is the first hour's trading. The initial balance on this chart that I'm showing you here is the yellow line. That's the initial balance. There's the first hour's high today, 1421 and a quarter. The first hour's low, 1409. There's a ton of stuff you can create, a ton of setups you can create just based on that particular fact that the market trades the first hour, and marking that with the IB, and then it has certain behaviors that it does fairly consistently.
Let's talk about today. So Robert and several others have a question. So let's see if I can wrap them up into multiple questions into one here. So today, we had a very P-shaped profile, P-shaped distribution. Now let's talk about days like today where we kind of melt up in the afternoon. I also want to ask you about responsive versus initiative buying and when you could see the difference this morning. Also, let's talk about, how do you frame today? When you saw today open outside of yesterday's value, what were you thinking? When you saw us trade at the very top of the initial balance, what were you thinking? What are you using for targets? What's running through your mind on a day like today? Are you taking only longs, etc.?
Okay. I'll preface that by saying that I did not actually trade today. And the reason I didn't trade today is because I'm setting up a new office. We're moving in about a week and a half. But I also had to be on a panel at the FIA Expo here, the Futures Industry Association. I was invited to speak on a panel about social media and so forth. So I missed a good chunk of the morning. And when I come in and there's just so much stuff to do, I generally make a lot of errors and get frustrated. My trading's poor. I recognize this because I've been trading so long. It's a good day for me to force trades. So I didn't trade today, so I want to say that. And it's my goal to, having sat through a whole bunch of these webinars where others speak, it's my goal to provide practical information as opposed to theory. Like I can look at this chart and say, well, you should have gotten long at the open at 1410. It sold 1425 on the close, but the actionable information that's available on this chart is, from my perspective. And these are volume profiles right here. This gray, the dark gray is the value area of that volume profile, not market profile. Market profile looks more like this. That's market profile. If I zoom in, you'll see the market profile letters, okay? The difference between them is I plot the volume profile on the market profile, so you can see in bright green here, this is the actual volume, and then the letters represent traditional market profile, which are each one of those letters is called a TPO, or a time price opportunity, and it measures 30 minutes of time. And I moved away from that back in 2005 when, having CQG for charting, I started to see that, look, I have this accurate data, I've got volume, the profile is often blunt, it's not telling me much, and today's an example of that. It's showing a pretty blunt set of TPOs here, the same number of TPOs, so it's traded this price range forever. Today, the same amount of time. What is that? 8-9 periods. It traded the same prices. But look at the volume. The volume speaks louder than time on a short-term basis. Now, if I was looking at a profile that's enormous, the volume blends in with time and it's not as important. So if you're a swing trader, if you're doing homework on a very, very big level, that's something else. So to answer Mike's question here, for me, coming in, opening out, is this a balanced day? It's not an ideal balanced day. An ideal balanced day looks like just a normal, a Gaussian curve, more like, hang on, let me turn off these zigzags. Boom. Okay, a normal day looks like this. So a clearer chart's is this chart here. This chart only shows me the volume profile. So a normal day kind of looks like this. It's more Gaussian. This is a Gaussian curve, or an evenly distributed balanced day. The value of that profile has a lot more impact than, say, this. This has no value. The market's saying loud and clear that I can't find a valuable price. I can't find a fair price. And therefore, I'm going to keep going down and going down and going down and going down. This is a trend day. It broke all the rules for a balanced day. It has a thin, choppy, toothy profile. It has a wider than quote-unquote normal or common range for the day. It closed near the low. The point of control, the volume point of control, followed the day down, although it stopped here midday, so on and so forth. And that day does not have value. By definition, a trend day does not have value. The only reason the market trends is because it can't find value. So essentially they say, how about 1430? No, nobody wants 1430. How about 1429.75? How about 29.50, 29 quarter, 29? Come on, guys, 28.75. All right. How about if I pay, how about if I pay 25? How about if I pay 24.75? And as long as it cannot find buyers to step in and hold it there, and create a volume, like a lot of volume depth, it's not value, because participants are not coming in. Well, this is the basics. This is the basic thing about auction theory, okay? So again, I still haven't answered your question. Coming in today, it opens outside of the prior day's value, and the expectation always is to go into responsive mode, which means to trade towards value, to trade towards the most valuable price of the prior day. The most valuable price of the prior day is 1406. You can see it protruding pretty heavily here. All it did is it pushed lower on the open into the prior day's IB low. So yesterday's IB low is today's IB low, and it couldn't, and value was right there, and it couldn't push into value, and it started to turn up. And I think I tweeted early on looking for 1428. I tweeted that yesterday. It didn't really go anywhere yesterday. It was surprisingly actionable yesterday. Expected the end of month, end of fiscal year to have at least 2 million contracts traded during the day session. It just didn't get there. It just could not push lower. So the question becomes then, all right, if it can't push lower and it opens so close to value, where's the weak hand here? Are the buyers the weak hand or are the sellers? If you're standing in a pit and all of a sudden it opens and everybody has their hands pointing towards the pit, in other words, they're selling, sell, 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 and then that selling's being absorbed, right? There's a buyer in there and they're absorbing all that selling, and all of a sudden all those sellers are standing there like with beads of sweat on their forehead as this thing pushes up. Guess what happens? They start to cover. The more important force, which is the third force, I cover that in webinar 3 on my website, starts to step in because it can see clearly that there's no action on the downside. And so if they start to step in, what's the next area to test? The next area to test is probably going to be yesterday's high. That's the most memorable price in recent history, 1450. Once it breaks through 1450, does it break it and fall back in and continue to trade? If it breaks it and falls back in and tries again and then falls back in, chances are responsive selling is going to come back in and it's going to drive it to 1406. And that's when I will tweet, caution longs, looking for 1406. It's very simple. The problem with trading, and I know Mike has a lot of guests that talk about technical indicators and such. The problem with trading is it's not the technical indicator. It's not the green dot, red dot. It's not the the awesome service you subscribe to or the awesome room you're a member of or whatever that's going to make the difference, in my opinion. It's the psychology. So even if I sat here and day after day you've watched me say, I'm getting short here, boom, hit the short, I'm scaling here and I'm exiting here, and you see it happen. One day you might decide, you know what, this guy knows what he's doing. I used to post my trades live in real time on Twitter. I'm restricted on that now that I'm registered, but if one day you decide I'm going to follow those trades, you're still going to have the same problem because it's not your trade. It's not your style. It's the moment of truth is right when you put the trade on and you feel a little bit of heat. When I put the trade on and I feel a little bit of heat, I might add to it if I have conviction. I might have taken a half a unit or a quarter of a unit, and I'll add to it because I figure that, there may be some buyers here. Given the setup, there may be some buyers here. It's not done going up, and I'm getting short.
I agree with you.
Yeah, whereas others are puking out. They can't, they have a 4-tick stop, and oh my God, I can't take it. But if you do the homework,
that's the problem though, is that no one, I don't want to turn this into a psychology webinar, and everyone I'm sure is tired of hearing me preach about psychology because I think it's so important. But when I'm as the administrator of the forum, I can see where everybody is spending time, what threads they're looking at, and I see these guys that have been members of the forum for 3 years, and I always see them in the same threads. They're always in these vendor threads looking at indicators and signal service, trading rooms, and always asking, hey, has anyone heard about this vendor? Has anyone heard about that vendor? And I'm telling you guys, I mean, you just, even if they're a fantastic vendor, which is a pretty big if, it's just, you need to really find conviction in your own method, right? That's what I believe. Anyway, I don't want to get too far off because there's a million questions, but I want to ask you specifically, FT, about today. So for the last 7 days, we've been in this 15-point range or so. We're making new highs right now in the ES. Roughly 1415 to 1400, and I want to talk because I see people get run over on strong trend days, which today, it was fairly strong. A lot of the range happened overnight, But I see a lot of people get killed on this type of day. And if you go back and look at the last 7 days, it was you could see like just a very, very slightly new high and then an immediate sell off, right? You see this pattern, or on the other end, slightly new low and then here we come with a little rally. Now today, when we approach that level of say 14, 16, you said that you weren't trading. I don't know if you were watching at that time or not. Or even if you weren't, if you can just go back to another day that's similar, I want you to try to describe in terms that people can understand so that they can look at this on their own chart and understand the difference of why you should not be taking a short, up there based on what you're seeing, because shorts are just going to get run over, right? What I found is that there was basically no retracement. Any attempt to move lower was not happening. There was a lot of rejection lower. A lot of fuel, then we started seeing initiative buying coming in at those new levels, and of course we continued moving higher. What did you see, or what do you see on your charts?
So let's play this back, okay? I could do the playback feature in this in Investor RT here, but it takes a little bit to load the tick data and run it again, so it takes a while. We'd have to sit here, but just humor me and watch what happened. This is a 2500 volume chart. This is my most common chart. It's not the chart I do homework on. I'm looking at bigger time frames, but it's the chart that I watch. It's the chart that I do most of my statistics on, that I understand. It runs at the right speed for me to make those decisions. We open up, so here's the opening bar right here, 1410, okay? We open up, we test up, we test down. The test up and the first test up and down are called the opening swing high and the opening swing low. Not opening range, has nothing to do with time. Not interested in time. I don't care about time. Time to me is irrelevant in the trading environment that we're in, except that I have to watch out for economic news and the fact that the market's opening or closing. But other than that, I don't really care. I don't trade off of minute bars or whatever. So it puts in the high swing and the low swing. The low swing goes in against yesterday's initial balance low, the first hour's low, and against the value high of yesterday's trading. Then watch these bars. Pulls back to the midpoint and the open. Nothing says short. Pulls back 1 point, pretty strong. Pulls back 5 ticks, fairly strong. Finally you get the pullback, and we're approaching that number that was coming out. Still to the midpoint, so nothing to me says get short, dude. There's the test of yesterday's high. So here's where I would expect a 1 or 2 tick test and a fallback into the range. And this is important because if you had a huge number of contracts to sell, if you were managing people's money, an institution, let's say, a fund, and you wanted to get short, it probably, given the configuration that we're in, it probably would help you to see that we took out the high by 2 ticks, couldn't get anywhere. I would feel much more comfortable getting short under those circumstances if I was a long-term seller. Let's say I'm working a 100,000 contract position. This is another day where I'm trying to continue to fill my short position because I'm bearish on the market. You want to see that 2-tick pop before you take it back down, right? It tells you that, look, if the buyers were strong, there should be a stop run here and it should continue higher fairly aggressively. We just took out yesterday's high. But what happens? Here, it sits sideways, it taps against it, and it goes higher. Nothing here says to me that I should get short. There's no homework level, and I outlined my homework levels on Twitter. You can just follow me on Twitter, FuturesTrader71. And I said 1775 is the goal. 1675 is the last high in this area. That's this high right here, 1675 right here. So expect a small reaction, 5-6 ticks. And it goes to 1775. Now I'm starting to get interested because now it's against my homework level. 1775, this pink line right here. Let me expand this chart. This pink line right here. Okay, 1775 also comes from way back here, pre-ECB time frame. It's that high of this whole range, this micro composite, I call it, of balance. So I'm interested now. This is my first opportunity to explore a short, but I'm still not seeing signs, and this is what the tape's for and so forth. I'm still not seeing signs that this is going to be done. I'm not seeing any rotations that lead me to believe that, you know, down here I had sort of a setup, but it was too low, 1675. If I had, I'm not going to get into setups. I think I'll probably, I don't know, spur a whole bunch of questions I don't want to answer. But this is the first shot across the bow right here. All along, other than the midpoint test here before we took out the high, all along, the best pullback we had was a point and a half, boom, 2 points. Okay? Now it's got my interest. Okay? Double top at the IB high, 82% probability. Double top at the IB high, 82% probability that that will be broken. That's homework. Okay, so now I know that that's a caveat. Hey, I want to get short here because it's against the level I'm interested in, but I've got this very high probability that it's going to get broken. Okay, boom, it breaks. So now forget about that. Now I'm looking at 2250, actually 2225, which is carried over from, which is a level from 1022. It's what's called an LVN. It's a low volume node. Sorry, you have to bear with me here. We're going back a few days. 1022. We got to go all the way back here. 1022. So that's this notch out here. This double top resistance for me, it's 225, 2225 right here. I marked it on my charts. You'll see it on my charts right here, LVN. Those are my homework levels right there. That's how I mark my homework. 1022 LVN. Now I'm interested. Okay, it broke. Where did we stop here? We stopped right when it broke higher. It's approaching that 2225. Now I'm interested again. There. Now I'm looking for a good sized push up. The IB is in. So this line will stop going up because 9:30 has already passed Chicago time, and now I'm looking for the quality of the move up. This is a fairly strong move up. I will take a chance on it. My stop will probably be somewhere between 6 and 8 ticks.
Now let me ask you one thing that's relevant to this. So we always talk about the importance of waiting for the market to come to your level and et cetera. But now a lot of people have a very hard time. Let's say that the market, already moved up at this point, 15, 18 points from the overnight low. A lot of people have a rule that says, don't chase a trade. It's really hard sometimes for people to jump in on a long when you're buying the top of a range. Now, talk to me about that.
So the reason I talked about the fact that I already set up the long here, if you remember, as I was running through these bars, I was saying I don't see the reason to be short. And I'm addressing the question of, where would the short setup be, since, once it breaks through the high, the next thing you have to do is wait for a pullback and go long. I don't have that in my plan. I don't have a trend day setup. For me, the long should have happened back here. If it didn't, then I have to wait for my next areas where I expect a reaction.
Right.
So I'm not going to answer the question of, look, this is a trend day up. Sure. Let me pause the screen here for a minute. Go to a day in the past, and then have someone step up and identify if it's a trend day up or down in the first 10 minutes.
Right, yeah.
It's a very hard thing to do. It's a very easy thing to do and discuss and argue about after the fact. But tell me, what happened here without looking at your charts? Should you be long or short here? Is this good enough to be short? Have you at this point missed the trend? Is it coming back? Is it done? Is it going to go up now? Would you be selling into an up move? Is it down on the sell side? You know, so I'm only interested in the next setup because the action's on the hard right edge.
Yep.
And I, to be honest with you, I can sit here and come up with some answer for how you'd get long and catch this whole move up, but that's not my style of trading.
Sure.
My style of trading says trend days as defined by, you know, just like 6 factors, happen 18% of the time. It fluctuates between 17 and 18% of the time. Those are the days I don't do well on.
I think that, okay, I think that generally when people get crushed on a strong trending day, you know, today I think that it was actually not as bad because we went up in the open and then we just kind of went sideways. But on really strong trend days where we just keep pushing all day, people getting crushed, and what they're getting crushed from is taking shorts, you know, in this case.
Correct.
So even if you can't jump in long at the top of a range, which is not, you know, not necessarily a bad thing, you know, okay, at the very least, don't take shorts, right?
Right, but here's the thing. I can make money and have made money going short on big up days. And it's because I have a plan for that, yeah. and I don't press the shorts.
Yeah,
you know?
I took some shorts today too at predefined levels. You know, going back to, I think it was the 1022 point of control. I took a short, like pretty much a few ticks from the day high that gained me, you know, several points. But typically, you know, you don't. People that lose big on trend days are generally because they're against the trend. So
true, but you see. This could be a very long discussion because trend is an opinion. It's a lot like religion. You know, it's trend to you is not trend to me because I might be operating on 1 minute bars and you may be looking at 60-minute bars.
Sure.
The market will pay both ways. The market will cost you both ways. The question is, what do you have in place to protect you from when you're wrong? People, I'm looking at the risk screen for the brokerage right now, and I can see that actually, even though it's a trend day up, it's fairly balanced, except there are a couple of big doozies at the top who've lost a lot of money, and generally it's due to the fact that they just do not have control on when they're wrong. The bottom line is this. The bottom line is you, nor I, nor the guy who has 15 quants in his office knows where the next bar is going to go. And the fact is, and I'm going to open a can of worms again, the next trade's outcome is unknown. It could be a winner, it could be a loser. So what factors can you control? You can control the duration of the trade, the speed of the trade. So I might be someone who sits there and has an oscillator or whatever that says, hey, catch a point here, catch a point here, catch a point here, catch a point here. And by the end of the day, I could make as many points per contract as the person who bought 1410 and held it till the end of the day. This is the beauty of the market.
Oh, yeah. So I agree completely. Oh yeah, I agree. I'm just talking about, like, I saw some posts today where people lost their rear end today, and generally it's because they refuse to, they have a problem being wrong, right? So they either kept adding, or they kept moving their stop back, or they just were unwilling to accept that they were wrong, you know?
Right, so, and the reason for that is because they got smart. They got smarter once the trade is on. And that's a big problem. Yeah. That's a big problem. They put the trade on, and I say it all the time in our chat room. I say it all the time to our traders. You are not smarter once you put the trade on. In other words, if I'm going in with a quarter unit or half a unit because I'm fading the trend, and I'm aware that I'm fading the trend. Why? Because we moved from yesterday's range and out and continue up. So any shorts I take are going to have a quick scale. I'm going to secure my risk, And then any runner that gets scratched at my theoretical average or my entry price. I am not going to get smarter just because I entered the trade. If my setup is take 3 contract or 600 contracts, it doesn't matter, and you're aiming for a 1.5, you're risking a 1.5, you're looking for a probability of around 65–70% on the setup, and I go and I say, you know what, this isn't moving fast. It's going against me, but it's not moving fast against me. Let me add another unit and turn it into a full unit instead of a half unit. That's garbage. That's a loss of discipline. You're violating your plan, and you think you got smarter because you're in the trade.
Right.
The fact is, you don't get smarter once you trade, but everyone here thinks they do. Everyone believes that once they're in the trade, now they can make an objective executive decision on how to manage it. And really, you cannot, because there's so much stuff happening in your brain that prevents you from doing it, and it is almost the exact same stuff that makes people drive after having a few beers because they're feeling okay, you know. And the fact is, you're the last person to know whether or not you're able to drive. Only a breathalyzer will figure that out. But to the person themselves, they think, I know what I'm doing, you know, I'll be okay, I can walk, you know.
I've learned over the years from very painful losses that I prefer to know exactly what conditions, if they were to occur, are going to cause me to get out of the trade, you know, or have a predefined target and stop, you know, and just take it for what it is and move to the next trade. Okay, I want to move on to some other questions because there's about 5 million of them. I'm going to jump around a little bit, so apologies. Ryan says, with Vanguard, your brokerage, there's no fee for ICE data like on the Russell or the dollar, and other brokers are charging for that data. That's news to me. I thought that ICE was always free for brokerage. It's only a fee whenever you're doing it on non-execution providers like DTN. They have to charge an exchange fee. What do you have to say on that?
So the question is, we have it for free.
Right. But he's saying, he says you have it for free and other brokers don't. I didn't realize other brokers didn't have it for free. I thought it was always free.
Yeah, I cannot address that.
Okay.
Again, you know, my broker here, my partner Anthony, saying that is correct. That we don't charge a fee for the ICE data on our trading platform, but I would be the wrong person to ask why.
My understanding is that if you're executing on a platform that executes, it's free. If you try to get it from like DTN, then they have to charge you.
Yeah, and all data feeds have to charge you. You know, we get exchange waivers on the CME and so forth. We give our clients the exchange waiver to get the free real-time data, but ICE doesn't provide that, so we can't offer it. But your data provider is going to charge you for one way or another. They're going to charge you for that data. But it's best to write to client-services@vanguard.com and get specifics. I don't want to step into something I don't fully know. I'm just a dumb old trader.
All right, let's briefly talk about membership. I think the number is somewhere around 1,000 turns a month, and that's when it becomes cost advantageous to be a member. And there's different memberships for different exchanges. I'm assuming that's something that you guys can help if someone wants to contact you, and you can help them locate leases and such.
For membership?
Right.
Yeah. One of the things that I envision for us doing for our clients, and we do it, is to, like today, part of what I did today is I downloaded this massive amount of data that shows our traders' trades, and then I put it through an analysis, and it's not because I'm trying to crack their system or whatever. I'm not interested in that. I put it through an analysis to see what their performance is as far as how much they're trading, what products they're trading, and so forth. And my goal in that analysis is very clear, and that is, how is this client's pricing versus their activity? Are they at a point where they should be looking at an ECM membership, a lease membership, or even buy a seat? You're trading the Dow, let's say, full time, and for right now the exchange charges $3,000. That's it, $3,000 to buy a Dow seat, the item seat, which used to be $65,000 in 2007. You know, for that, you start to trade the Dow for, I think, 9.5 cents a side or something like that, plus,
Yeah, it can
plus
be
clearing and commissions.
Right.
That $3,000 will be paid for
Sure.
in a few months. There's a $2,000 application fee for anything you do with the
Right.
exchange. But those are the types of things, those are the quote-unquote value adds that
you can
we
definitely
provide.
pay for it so very fast. And I wanted to ask a personal question to take advantage of having you here, and I'm losing my voice, sorry. I've often wondered, you know, me and a couple of really close trading buddies that I would trust implicitly, I wondered if there's a way to do some type of an LLC where we can all come under one roof and get, you know, membership pricing. But my concern was taxes and stuff. Do you have a quick answer? Or
Yes, the quick answer is don't do it. The penalties for that can be up in the millions of dollars.
oh, really? Is it technically illegal? I didn't know.
The reason is what you're trying to do is create what looks like a prop shop, but to do a prop shop, it means that the company is taking all of the risk. In other words, there's no risk capital from any of the participants, and the company's liable for those traders and cannot pay more than 80% of the net profits. If multiple people put in their own risk capital, or if you're asking them to reimburse you for deficits or losses, you're basically competing directly with the exchange. And what the exchange does is it pulls that membership, and then it looks back at all of your trades and charges you the full fee for those trades and says pay up.
Okay.
And that, you know, if you run your shop for 2-3 years and rack up some real high round turns, now you're looking at a big tap. You know.
Well, maybe that's why I couldn't find information on doing that. All right.
Yeah.
Okay. Oh, sorry. Losing my voice.
Wow, there are a lot of questions. It'd be interesting to see you get through these.
Yeah, let me try to jump and let's see if we can take some of these out. David says, I don't understand, maybe you will. What's your favorite activity at your brokerage, and what do the clients enjoy the most?
Favorite activity at the brokerage. We have, you know, the chat room that's in there, it's called Traders Helping Traders, and it's exclusive to our clients. The goal of doing that is, look, I'm not interested in pulling people from other brokers for the purpose of collecting commissions and, you know, going to, like, some of our competitors, just finding out what you pay and then dropping it by a few pennies around turn or whatever. I'm trying to change the way individual traders trade on their own. Essentially what I'm trying to do, along with my partner Anthony, is we're trying to create what looks like a remote prop operation. In other words, we're trying to create a structured environment that is conducive to communication about the markets, not about what you ate for lunch yesterday, no arguing, nothing like that. It doesn't have to be a specific methodology. There are people in there who use you know, moving averages and MACDs and stochastics and RSIs and whatever. They couldn't care less about volume profile. It's not about me. The idea is to create this environment where people support each other. I shouldn't have to answer every little question there is about how to do this and that in the trading platform or whatever. They help each other out, and then we do group trading sessions. Like I just fire up a session, and you know, anybody that wants the mic can have it, and we trade through the open, and maybe for the next hour and a half or so. I try to do that about once a week, and with this move coming up, it's been tougher. And that's my goal. My goal is to take you out of the, you know, I'm in the basement, you know, by myself, and I'm going on these different outlets to create a community because I don't want to trade alone. I'm trying to not compete with forums like Big Mike or anybody's chat room. What I'm trying to do is create an environment where you have almost like AA sort of, Alcoholics Anonymous, almost like those group meetings where you have a place where you can go to address an issue. You can contact me or your broker through this room, and that's I think that's drawn a lot of people in. I mean, the room houses a pretty significant percent of our total client universe that we currently have, and we've grown quite a bit. We've been running for about 10 months or so. We've grown quite a bit because of it. But the fact is, that's, I think, seeing, like, I've known people, I get to know people that are there, that are our traders. I get to know them pretty well, like I did with my prop traders. Much more personal when they're face-to-face, but that is the best part, I think, for both sides, for myself, for the brokers here, and for the client. Like, I keep an eye on certain traders who I think really have it in them to push along. I can see their progress. I can, at any moment, pull down their trades, do a quick analysis, and see, like, this guy's getting a positive expectancy, or this one is not having a $2,000 blow up once a month. It's starting to sink in. It's starting to, the whole risk psychology part of this is starting to sink in, and I'm happy to see the results of it. And I think as one person makes it and they talk about it, others get excited, and it creates this new hope. And it's not a false hope, sure, like you would with some indicator or something that's being sold. It's real. Now, with that, there is no guarantee of success. There is a risk of trading. There is no, I'm just giving you an example, and I have to balance it with the fact that there are probably an equal number of people who struggle and may come and not find what they want and leave. We cannot guarantee your success, and that's not our job. Our job is not to make you successful. Our job is to create an environment that helps you in that sense. Whether or not you're successful, whether or not you make money at this, is really up to you.
Here's one more Vanguard question from Mike Schneider, and then we'll move on. What was the hardest thing about starting your own trading firm?
Not knowing what I was getting into. I mean, when I was trading for a prop firm, I had the intention right away to do it for myself under that prop firm, maybe a different office or whatever. So I learned the ins and outs of servers and connections to the exchange, and then I became one of the trainers at the prop firm in addition to trading, and the only reason I did is because I was able to make the turn and become successful and so forth. I think the hard part about prop is the fact that you are it. The buck stops with you. In other words, if there's a flash crash and your traders have an enormous position on and something happens and you're out, huge money, that's money that's coming out of your pocket, your bank account.
Yeah.
And the other part is the market reflects personal psychology. And people are quirky, people have certain beliefs and certain attitudes that are very, very hard to change or adjust. And at the beginning it seemed to me like, there were times where I was going, gosh, what am I doing? How am I going to change this person to start really looking at the market for what it is? And that is to become comfortable with the unknown. The biggest thing most people struggle with is the fact that you don't know what's going to happen and you're staking your money to find out. And that's a hard thing for people to accept, but you just have to be well capitalized to do a prop thing, and it's harder these days to do that because it's a more competitive environment, and
right,
the exchanges are much more friendly to the HFT, systems
sure,
type people.
Well, I see on the forum all the time, the only question that most people ask is they want the broker with the lowest margins, and I guess there's always going to be people like that are. It's like with the election. What do they call them? They call them low educated voters. There's an acronym or something for people that we really don't know what's going on. And I guess there's always going to be a similar aspect of that in the market where people are just, they really, if you were well educated, then you wouldn't be asking for the cheapest broker, Okay.
Yeah. And that's, I'm talking from the perspective of a trader rather than a broker. The $500, $400, $300 per contract margin, it doesn't mean diddly. It really doesn't factor in. And the fact that you're paying 10 cents more here, 10 cents less there per side or per round turn, it doesn't mean a darn thing. It really doesn't. I know I don't handle those commission calls or those kinds of calls from people. The brokers do, but I hear them having discussions about, look, can you cut me a deal for 5 cents here and 5 cents there? And then the guy comes in, and the first few days he's out $2,200, on one trade. To me, that's not what should be important. What should be important.
But he saved 10 cents though.
Yeah, but you saved 10 cents. It costs you $2.50 less to lose the $2,200. But to me, it's like, as long as there's a stable platform, and as long as you have a community or an environment that helps you in whatever you're trying to do, I think that's much more valuable.
All right, tons more questions. We'll see if we can get some of these knocked out. Michael says, I'm going to elaborate on this a little bit. Can you give us a breakdown, like roughly percentage-wise, of how many of your trades are scalps, how many are day trades, how many are swing trades, etc.?
There are no swing trades at all. I don't hold anything overnight. I would have to be way green in a position and really have some serious conviction to hold anything and put up the margin for it. So no swing. Setups that I hold for anywhere from 15 minutes to sometimes in the ES it's like in August 6 hours. I would say those are probably, from a volume perspective, they account for maybe 20% of my trading. The rest are getting in, banking my risk, in other words, funding the trade, securing my risk, and then letting something run, and it generally stalls out fairly quickly. These markets do not have the trending capacity like they used to. They will again soon, I believe. That's just my opinion. But for me, I consider that a scalp. It's not something that I hold all the way to the main target of the day. I'm just, on average, I'm looking for 2 points per contract in the ES. That's it. If I can take a trade and get 2 points average per contract on the ES, I've done my job, and I can do that at a fairly high percentage. And that's all I need. That's all I want.
Do you find yourself changing directions often during the day, or are you typically with one direction?
No, I always change directions. For me, that's one of the pains of like trying to tweet or trying to help people follow along, is that I might set something up and see something setting up the other way, and we'll take it and may not post it because I'm immersed in my trade, and then all of a sudden folks find out, whoa, you were short that? You were talking about long,
Right.
But I will change as quickly as the setups change, just like I talked about earlier, like stalking the short against 1775 and then seeing it tap the IB, this yellow line, a couple times. I know right there, wait, there's an 18% probability that this is going to hold. That's not a good probability, so I'm gonna change my mind and look for the higher trade or try to find a long. I don't have a setup for a long now.
All right, I see a lot of questions talking about homework. Let's start with this one. Michael says, how can you incorporate statistics into trading? Why not just trade what you see in real time? And I want to add to that. So, I see people, like we had that big thread on statistics, and there have been a few posts in there that says, this thread is a waste of time, basically. And, there are some people that believe that, historical stuff, those numbers we talked about earlier, basically have no bearing in what's going to happen next. So let's talk about that. And let's talk about homework in general. I see a lot of people asking questions as to like, what's your ritual? Do you do it in the morning for defining levels or coming up with game plans throughout the day?
Okay, so that's kind of a two-pronged question. To the question that, to the idea that historical stuff doesn't mean anything to the very next bar. Again, the market is just a mathematical representation of sentiment, period. If I came up to you, Mike, and I punched you in the gut, what is the probability that you would punch me back? Right? And I'm willing to bet that you'll probably punch me back, depending on, you're going to weigh like my size versus yours or whatever,
Right.
and you're either going to run or you're going to punch back, right? The market's the same. It doesn't mean that the statistic has to be to the 4th decimal place. That's not what we care about. We care about the tendency, and that's why I always tell people when they're doing statistical homework, always state your thesis up front. Always state, I'm going to take a chart of this duration, I'm going to look for this specific thing using these parameters, and then do the homework, answer the question, you're done. Otherwise, what happens is people get so immersed in it and break it down and look for tick data and look for this and look for that, and in the end, their result, which took 3 days to get of number crunching, and my result are off by 3%. Who cares? The idea is to develop an understanding, a mathematical understanding of a tendency. That's all. That's all. All I want to know is this a 50-50 coin toss type probability that this would happen, or is it more like 70-30? 60-40. That's all I want to know. And then I can size my trade or add other pieces of information, other pieces of context that help me push that percentage higher. Push it higher from 60 to 83.2 or 83.4. I don't really care. Just push it higher. Then I'm willing to bet on the unknown that in my favor over a long period of time or a large data set, that particular edge will show up. It may not show up in the next trade because it's a loss, and the one after it's a loss, and the one after it's a loss. But eventually, in a large data set, I should realize that edge. Homework. I have a webinar. I am not, I do homework. I post my hypotheses in the morning as much as I can on my Twitter feed, but I've been asked this question so much. I created webinar 4.1 on the website. Again, it's a token price to see what I'm talking about, but it's I just go through how I'm looking at things. It's very basic. The question I always try to keep in the forefront, and always gets lost in all these conversations about homework, is what is the context? What is the context? If I don't have a context, then my homework isn't worth anything and my statistics aren't worth anything. So the hardest part about homework is defining context. What is the market? And the way you define context is you answer some really simple questions. What has the market done? What is it trying to do? And how good of a job is it doing in getting there? And those are way back from the Pete Stadelmeyer years, but they are very, very true. And then there's a fourth question that comes off of the last question, and that is, what is more likely to happen from here? So given where we were, given the quality of how we're getting there, where we're trying to go, what's the more likely thing that's going to happen in the immediate future? And that sets up my trade. Right? And so that's what I'm looking for. That's why I don't use indicators. Like if you look at this chart, there's a VWAP, there's a midpoint, but pretty much everything is based on price or volume, and it's not a lagging indicator of any kind. I'm not interested in those. I'm looking to trade off of context, because the moment of truth is when I put the trade on, and I don't want to know that I'm not going to get short because my stochastic's at 92%. I get short, and it stays at 92% even though this trade is ripping against me 6 more points, because the way the stochastic formula works, it can't move that much higher without huge moves. You know, it can continue to be at 92% and look overbought for a long period of time and 20 points later. So to me, you know, I used to use that stuff. I'm not speaking out of an experience. To me, that doesn't help me. What I want to know is, what is it trying to do? Is it in balance? Is it out of balance? It changes the way I trade whether or not the market's in balance or isn't. I hope that answers your question.
Sure. So most of your homework is taking place like what, like an hour and a half before the open, something like that?
I don't need, really for normal homework, I don't need more than maybe a half hour at the most.
Okay.
And throughout the day, I'll do statistical studies. Like, I'm constantly doing and posting statistical studies to our traders and to the Twitter feed. Just updating, refreshing, catching anomalies, things that maybe can help me or others set up trades or set up their bias. You know?
Right. Okay, I see multiple questions here talking about overnight. So let's talk about the overnight session and your reasons for building RTH profiles. Do you ever look at overnight profiles? Do you ever look at 24-hour profiles? What about overnight levels in general? Do they ever play a part in any of your thought process as to what will happen during the cash session, etc.?
Okay, so I do take those into account. When I come in, I always look at the overnight session by itself. So I switch the session to overnight, okay? And I look at what happened there. What kind of a profile do I have? Is it a balanced profile? Is it an imbalanced profile? This software automatically posts for me the overnight POC right there, the overnight high, the overnight low. It automatically shows me where that is because I use that information. Other than that, I don't really use anything else. If there's a big fat distribution, let's see if there's a day like that. Most of the overnight sessions have been really choppy. For example, let's look at this day here, right here on the edge. See this day where the overnight session started here, traded, then popped up, and then traded, held this upper part. I make a note of that. That's important information to me.
Okay,
when
but
this type of thing happens.
But like for your RTH charts and profiles, all of your BOCs and value areas or other levels of interest are primarily driven only from cash sessions. Is that right?
Yes,
okay.
That's correct. That's correct. And then the other stuff, like for example this level, I will mark it here. I'll show you. I will mark it right here, and I'll name it. I'll say whatever that date was, 10/20 or whatever it was, overnight LVN zone, and it'll just sit there until it's tested or we do something with it. So that's what I marked just now right there, and I'll pay attention to it until it's tested during the RTH hours. Once it's tested during the RTH hours, I delete it. It's no longer important. And then I also look at the 24-hour session as well. I want to see what happened, and the software splits the profile for the 24-hour for the RTH from the overnight. I can merge them, but I prefer to see what happened when.
So would you say that maybe the two most important figures out of the overnight data is simply the overnight high and low, since it plays a part statistically in the cash session?
Yeah, and then and then the overnight VPOC, the overnight volume point of control, which is this price here, the most traded price overnight. Actually, it's this price here down here. Where we open versus it tells me, helps me, doesn't tell me, it helps me determine a little bit more which bias there is. So if I know that we're close to the overnight high as we approach the open, and we've left the overnight point of control below us, then I'm going to look to buy anything. I'm going to look for an area or a setup to buy into any selling in that situation, because my bias is now for that statistic, the 96% statistic, to test the overnight high. It's tougher to go through the point of control, the overnight point of control, and go to the other side all the way down to the low if I'm already above it. In other words, it found balance overnight and it opened above it. To me, that's all. The buyers are coming in earlier and participating earlier. I want to be one of those. You know.
Rob has a question about VPOC shifts. Let's talk about those. So, as a cash session is unfolding, and you've got your developing value areas, and your VPOC is, let's say, it's moving higher. It continues to shift higher and higher. What does that tell you? What are you doing because of this? What's your mindset?
A lot of people ask me that. It's to answer that question, you really have to understand the auction itself. But the question you have to, I'll answer that with a question just to be facetious. Why is it shifting? What causes the point of control? Again, the point of control is the price that is most traded during the session. That's what the point of control is. So this price here, the 1422.50, was the most traded price. So if I show the volume, you'll see that this price here traded over 100,000 contracts during the RTH session. What causes that to move? What causes that to move up? If the session is trending up and all of a sudden you have a VPOC shift to the very top of the session, you know, the VPOC was down here, and all of a sudden it shoots up and it goes all the way up here. What is that saying? So instead of giving you the answer, we'll own it. Why don't you consider why it's happening? And then you won't need me. That you won't need my webinars and keep paying for things that I'm disseminating. I'd prefer that. The reason the VPOC shifts to the high, and the only way it could shift to the high, is not because there are more sellers. There are never more sellers or more buyers. They're an equal number, because that's just, for every seller there's a buyer.
Yep.
The reason is the sellers are more active. The sellers are becoming more active. So the only reason this VPOC would shift to the high of the day, for example, is because this price is being seen as too expensive. It's now advantageous for the sellers to step in and try to push back. If I wanted to get out, I'm going to offer that price. And if I see that an awful lot of people are sitting there trying to get filled, I'm going to hit the bid and therefore move that VPOC up. What does that mean? It doesn't automatically mean that it shuts off further buying. Because the answer to that comes next. What it means is, hey, this price was interesting enough to get a whole bunch of people to trade, whereas this price down here was not interesting at all. And that's what I'm interested in. So the VPOC shifts, and so the next thing I'm looking for is, okay, so now we're trapped in value. So before the VPOC shift, this value area was down somewhere wherever the VPOC was. Now price is trapped in value. So the first consideration I have is the trend may be over, maybe over. 2, this is likely to get choppy because we're in the most traded price of the day. Okay, and you can't consider this in the first 10 minutes of trading because it doesn't count, because the VPOC is going to be bouncing all over the place. In fact, I can have it draw a line to show where that VPOC movement is. You can see this white line here. That's where the VPOC goes, and it ended up here. So as the day begins, this VPOC's moving quite a bit. You know, you can see it. It started there, came down, went back up, then it bounced up here, then it bounced up here, then it bounced up here, and so on and so forth. The VPOC's not that important to me until the IB's in, until the first hour's in. Then I start to look at, okay, where are they settling down? The first hour of business is done. Where are they settling down?
Right.
If the VPOC shifts up and then we start to push higher and then we start to accelerate, because remember, a lot of sellers stepped in, and I don't know if you've ever looked at the statistics, but the open interest in the ES is a certain number. We trade a multiple of that number, which means that the open interest, those people who are holding overnight, are a certain number. I haven't looked at it in a while. The daily volume is a multiple of that number, which says that probably more than 60–70% of the volume that's going through is day type volume, is local volume or day traders. So it's short-term volume. If the VPOC shifted up, it means a lot of sellers came in order to form this volume profile. And if the market gets stuck and then suddenly it pushes up through it and above it, then I'm looking for a lot of these people to puke, because remember, most of the volume is day volume. They're short-term traders. Okay, and if that happens, then we're going to leave value behind, and we may resume the trend. And this was just a break, a pause. So there is no definitive answer. Again, the context matters, but you have to ask yourself, why did that happen? You know.
Let's talk about composite profiles and microcomposites and merging profiles together. So talk to me about, well, let's look at the last week, for example, since we were very balanced. What rules or methodology do you use to merge profiles together or to draw a micro composite? Are you looking for a certain type of range of being more or less balanced within value? How do you decide where micro composite goes? And then once you have a micro composite drawn, what use is it to you? What are you using it for? Why is it there?
Yeah, it's an awesome question. Micro composites are, even though I have a composite for the entire everything that has traded since March 14th of 2007, right here outlined in black and outlined in these colors here, these, that, and this are the same. I want to know what the balance areas look like. So let's look at that for a second. So I know that the market, here's the ECB announcement. We had a big pop. Then, hang on, let me turn these lines off. We had a big pop. Then we pushed higher the next day. We actually opened, tested a little bit lower, and then pushed higher the next day. The day after that, we took that back. Immediately, I'm drawing a microcomposite. Why? I want to see where the volume is, what that profile looks like in that area. So I want to see what's the most common price in this zone, what areas were left behind that could be tested. Here's 25.50. Here's another big area that could create chop. There was a lot of interest in this area. However, as we push below this area, there is nothing holding this back. And you can see when we came back to test, it just fell right through. It fell right through. And this is likely, this is likely to be tested. As the next day gets formed, here's this day trading inside of this day. There's more balance. I expand this further, and now I'm watching. Okay, now my most valuable price is 14.28. Gonna watch that price. 14.28 sound familiar? That's what I talked about for a target today, for a big target. And I'm still watching these thin, seldomly traded and very heavily traded areas. The next day trades within that range. I expand it. Now I'm looking, okay, how is this impacted? Is this becoming a more balanced microcomposite or is it not? Do I need to remove the Fed day or the ECB day and see what that looks like? What happens when the next day this happens? There's hardly any volume in here, so chances are the market's going to fall right through that down into this high volume zone, which is where this bar comes in, right? And that's what microcomposites are. It's like looking at a profile but looking at it for multiple days. So my rules for creating a composite is we have a trend day. The next day there's nothing to draw. It's just that day's profile. But if the day after that trades in balance, you can see that these are in balance, then I start to draw a microcomposite and I start to track what is happening here. This day here, 31.75, separates the price that is most accepted up here and the price that's most accepted down here. This 31.75 becomes a key number for this zone. Those types of things. The next day trades within that balance but shoots down a little bit. I expand it and I look at, oh, now we have a distribution at 31.75 with a neckline at 31.75, but we have another neckline at 24.75. So the next day I want to see what kind of a reaction happened at 24.75. And if I pulled up the daily profile for this, you'll see that there's the first time it's probable that the first time it moved into that area, there was a reaction. And what it did is there was a reaction, and then it fell back through, and where does it go? It goes to the most traded price of the prior day. And that's what microcomposites are for. It's the same thing. And then if it's a completely balanced profile, then I turn on the value area. Then I go in here and say, give me the 70% value area, and it shows me what the value area is. Like for this one here, this is a very balanced profile. So I turn on the value area, and if you look back at my tweets from a couple of days ago, I said, if we open up higher, it was this day here, if we open up higher, then I'm going to look for a test of 11. If 11 holds, then I'm going to look for 1675, 1775, and ultimately 28. If not, then I'm looking for 1407. Those tweets are out there. You can go check them. And that's how I use microcomposites. It gives me the big picture, and it gives me context.
All right, let's change gears just a little bit. You and I had talked about this in an email, I think, and someone reminded me, Michael reminded me, let's talk about back-adjusted versus continuous contracts and why you would use one versus another, what the differences are between them as far as support and resistance, and as well as true actual levels. And I want to throw in there, I want to ask you, do you plot a SPX cash chart at all?
No, I don't. That's the reason I plot an equalized adjusted contract. And by that I mean, if you don't have equalized data, and I have to give props to DTNIQ Feed back in 2009 when I was distributing to my followers on Twitter. Every rollover I would distribute my bars, my 1 minute data to them so they can have an equalized chart, and they took the initiative and actually put all their resources into creating that same chart automatically. And so I really appreciated that. They didn't have to do that, but the reason we do equalize is because if you didn't, then without getting into the details of premium and how futures work and what is a futures contract and all that, essentially by the time the December contract, which we're currently trading, by the time it expires the third Friday of December, the price of the futures contract is going to equal the SPX. It's going to be one and the same, but during rollover, that is the longest amount of time away from that expiration, and it is the largest difference between the futures and the cash. Why? Because the futures take into account interest rates until that expiration and dividends paid before that expiration. So the formula for a futures contract versus the SPX takes into account the current price of the SPX, it takes into account interest rates, the time left that you have to pay that interest on, and minus the dividends that are paid if you're holding the cash instrument that you don't get paid if you're holding the futures instrument. At this point, I think I've lost everyone probably, but these are the nuts and bolts of futures.
But like a real life example, let's say that you want to look at a VPOC level from 5 months ago. Why is it important to use a back adjusted contract? What would happen if you didn't?
Okay, so 5 months ago, we were in a prior contract which had a different premium to the cash index. If I don't account for that premium, the difference between the futures and the cash, and right now the futures and the cash have a negative premium of maybe 4 points. If I don't account for that, then my futures contract is not going to represent where the cash was at that point. And so I have to equalize it. And so if I'm looking at levels on this chart that go back to March of 2007. And my chart here, my intraday chart that I trade off of, carries, like these pink lines are naked point of controls that go way back. You know, in this situation it goes only back to whatever that is, the beginning of October. But if I scroll back and I scroll up, you can see that it's going all the way back to 15.20 and a quarter. The 15.20 and a quarter, when it happened back then, is the equivalent of that equalized amount between contracts. So if I know this stuff is really dry and it's hard to make it exciting, I'm sorry, but you know, when we rolled over the second Thursday of September into the December contract, there was a premium of about negative 7.5, I want to say, points. So in other words, the futures were trading for 7.5 points less than the cash market, than the SPX. Okay, so that's just for September. Add the June contract, the March, blah, 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 and go back, and you'll find that if you account for all of the dividends, all of the interest, all that stuff going way back to 2007, there's going to be a huge disparity between where the SPX was and where the futures was. I want to know where the futures were. So I want to equalize everything.
But there's a flip side too, right? Because while you know, to use your word equalize, while it adjusts that data for that price level, what about like a real cash high that happened 18 months ago? You know, if you're using back adjusted contract and you try to compare that cash high to like if we're approaching it today, you know, that's why I like to plot SPX. What are your thoughts on that?
I think a lot of people do watch the SPX. I have not found it to be. I used to watch it. It doesn't help me. I find that I'm more solid trading, and this may be you know, this may be a bias or whatever, but to me it doesn't really help all that much.
Well, I'm just talking about actual dollar levels, you know, actual figures, you know, if they're important numbers like, you know, 1474, it would not be the same number on a back adjusted chart. Okay,
so if we're arguing this out, I would tell you, all right, so that happened 18 months ago. Are the components of the S&P the same as they were 18 months ago? At that point, were the same dividends paid if the companies got switched out? Which was the leader? Which was the follower? How important is that high? If that high was put in by Exxon, predominating that index at that point, and right now Google or Apple is controlling that index, shouldn't I be watching an Apple or Google chart to see where that high is versus the SPX? It gets to me, the bottom line is I try to keep it simple, and I want to equalize because I want to know where the actual futures contract, which is the product that I'm trading, where it was in those terms. I don't want to, because if I didn't equalize, I'm going to have highs and lows that represent nothing at all.
Right.
They will not represent in today's terms even where the SPX is back then.
Sure.
So as much as it's inaccurate, and I would agree with you, it's much better than coming in one day on a Thursday and all of a sudden your chart has a 7-point gap that never really happened. When I equalize charts, it actually moves the prior data so that it's in line with today's trading. If I don't, I'll have a gap, and it'll show up as a gap on my chart. Did the gap happen? No, we just rolled over. So which is better? For me, because I'm trading the futures, I don't really you know, I want that I want my data to be continuous, equalized. I want my profiles to represent that. Again, it's more of like, you know, do you use a stochastic that's a 21-14-4, or do you use a stochastic that's a 14-14-3? You know, it's just whatever works for you. And for me, understanding the nitty-gritty of how the index was created, because I used to create this thing called the fast cash and create my own cash index and premium and watch it. I know that it's a really slippery slope as far as accuracy when you go back in time. You know, so I'm trying to represent it with volume information that's approximating the price of where it actually was in today's terms.
Right.
It's a lot like, just to elaborate just a little bit more, I'm watching this amazing series on the History Channel. It's called The Men Who Made America. It's really fantastic. And the first part, it talked about Vanderbilt. It talked about Rockefeller. Okay, and it talked about Rockefeller in terms of what he was worth when the first big depression happened in the 1800s. And it says in the 1800s he was worth X number of millions of dollars. Okay, let's call it $100 million. He was the wealthiest man in the world because he just dominated the oil market back then. He controlled everything. 98% of the oil market in the U.S. was controlled by Rockefeller. Okay. But in the context of me trying to equate that today, $100 million isn't much. Heck, I know a couple of guys who have $100 million. Not until they say that is worth $288 billion in today's terms, now I've got something that I can go off of. This is the same. It's the same analogy. I'm trying to represent old price in terms of today's time. Now, does $100 million in 18-something equate to $288 billion? That's arguable because, you know, is inflation real? Is it really 2.2% or is it 7% really? You know, you can argue all you want about it, but the fact is it just gives me a ballpark idea of where it was, you know?
All right, let's try to get sorry. Some other questions here. A lot of questions about your platform. So let's try to roll them all into one. Sorry for the noise. My dog is under my desk. What platform is it? Why do you use this platform? The profile and the tools that you're using, are they all part of the platform? I know all this, but I'd like for you to tell everybody so we can get on the same page.
So the chart that you're seeing now is by Investor RT. It's called Investor RT by Linsoft.com. Linsoft is made up of two guys who are just really fantastic, who've spent their entire career building something that's usable. Why do I use it? I use it because it pulls in as much tick data as I want or as little as I want. I'm able to make it do all kinds of crazy stuff. It has somewhat of a learning curve, but so does, you know, so does a PC when you first sit in front of one. You know, it's the best place to get information on it. I'm going to pull up a browser because I just don't want to give the best place to look at it is to go to vancar.com, vancartrading.com, go to trading platforms, down to Investor RT, and then it gives you all the stuff about it. You can go and sign up for a demo and so forth. That's what I use for charting. I feed it with DTN IQ feed. Why? Because it is much superior in my experience to eSignal and pretty much any other data feed out there. I feed it with IQ feed, and that gives me a ton of historical data, and it gives me real-time data that is adjusted. They have 12 technicians that sit there and sift through the data to take out anything, bad ticks or whatever for thinner products. They're very, very good at what they do. I grew up on CQG. I paid $850 a month for CQG for about 12 people for about 8 years, but I believe in this. I believe more in this. So that takes care of my charting. I run it on a separate machine, and then my trading platform is what's called the VK Trader. Also on Vancar's site, it's right here, trading platforms, and this is the OEC Trader platform, and I have a great relationship with them. They've made a ton of changes, improvements to it. Once I switched to it, I used to trade on XTrader Pro at $1,850 a month, and then I moved to CTS T4, and then once I started using this, it's free, it's included, and to me it was just as good in many aspects. Not only that, but this trading platform can feed your IRT charts or multi-charts or a whole host of other third-party products. So that's what I use. The trading platform itself has charts, but I don't use them. They're very rudimentary. The feed, though, from that chart platform is very steady.
And so just a few things that I'll add. Chad at Lensoft or Investor RT is a fantastic guy. It's a great platform, but if you already own a lifetime license of NinjaTrader or et cetera, generally speaking, you can get profile on other platforms too. But if you're going to try to, really mimic what FT is doing, then there's probably a lot of things that you're going to want Investor RT for, because otherwise you'll be spending a lot of time trying to reinvent the wheel when he's already got it in Investor RT.
The definitions on here are also very easy to pass on. Like, for example, the reason I show you that page is if you go to the Investor RT page on our website, at the bottom of it, if you wanted to grab the same chart you're looking at here, this chart, all you'd have to do is go into that and then just click on ES Intraday. It gives you this stuff here. You can copy and paste it into Investor RT and you would have the exact same chart. It just makes it easy for me to just help people transition into something else.
Right. But if you are just wanting basics of profile, then you can get that with some other platforms. Sorry about my voice. Real quick comment. Back in July, Gain Capital bought OpenECRI, and I was really amazed. It was only 12 million. I'm like, man, yeah, you should go buy them. I mean, that's not much. It really kind of surprised me, Anyway, it's just kind of a side comment.
The money is not in the purchase of the firm. The money is in the number of clients they have and in the incremental profits that it can make. And it's a battered industry. I mean, that's the reason why we're doing what we're doing. After MF Global, after PFG, we really want to shine a light on futures and say, look, you can go to trade stocks and put up $25,000 and avoid the day trader rule and all that stuff, but futures are much more, in my opinion, futures are just much more equitable. Everybody trades the same thing. There's no rumor on some drug that's being approved by the FDA or whatever. You don't get gap through your stop, all that. It's just, for me, and I used to scalp equities heavily. Once I moved to futures, it's more competitive, but there's so much more you can do with it. And the leverage could work against you, but it could also hurt you. But so you just have to have a plan for it.
Yeah, I was just kind of surprised. I'm looking at the old press release. They had $100 million in customer assets and 7,800 open customer accounts, and I was just kind of surprised. I thought 12 million. I mean, I know the industry is battered and everything, but they got a really good platform, as you said, and all those customers, and they have a good name and a good rating. It just kind of surprised me. Anyway, moving on. Derek wants to know how much weight you put behind the opening swing high and opening swing low. What was the significance of those levels? What happens if one of those levels is broken? How does it change your mindset?
Okay, why do I even have them? The opening swing high and low are simply measuring. It's a way of trying to measure the market on open orders. Those people who want to execute the trade at the open, I don't care at what price. So we want to see, that's the immediate force that's operating in the market. So I outline that in my 2500 volume chart, and I highlight it with these dashed lines here. To me, it's my very first measure of what kind of forces are in play. So if again, I'd refer you to the videos because it's just too much to talk about. I want to define what kind of an opening it is. Is it an aggressive one-way open? Is it a two-way open? Is it a two-way open outside of the range and outside of value? The most important part about the opening swing is when it happens in a gap. The open out of range, the open auction out of range, if this had happened way up here, I have a setup that trades off of these two levels. It's just a measurement of the first set of trades that went off and pushed price up and the first set of trades that went off and pushed price down. As soon as that happens, whether it takes 15 seconds or 8 minutes, I outline those because those are real important benchmarks, just like the opening range is for some people. But opening range uses time. I'm not interested in time. And you would see it in the pit. If you were standing in the pit next to me and I showed you that Deutsche Bank came in and just bought, and then the trades were done, and he puts his hands down, and it's over, and then all of a sudden, Morgan comes in, sells, then puts their hands, pulls their hands in, and they're done. That tells me that those are market on open trades, and generally they create an outline that is of levels that are tested again later in the session. We had a trend day today, so they didn't. But I'll give you an example. Let's say we had this 1375 double top and then the midpoint didn't hold. Midpoints for me are very important. The midpoint didn't hold and it taps into this 1411 OS high, pushes up, and then falls into the opening swing, falls inside of this boundary. There's a 78% probability that it'll test the other side. So to me, that's important to know. And that's just one use of it. So it's based purely on prices and the actual auction as it takes place, and that's what they're for. It's also the best way for me to catch a gap. The market gaps, it tests higher and then it breaks through the OS low. That's probably the only breakout setup that I have. I'm not saying everybody should take it and that it is a setup. Do your own homework and know the stat behind that setup.
I see just a few more Vancar questions. Let's see if we can cram them into one.
It's turning into a Vancar session.
Just real quickly, do you accept accounts from Canada and Australia and... I lost my place. Answer those and let me find this other one.
Anthony, are you there? I think now that OEC is owned by Gain, I believe that OEC will accept accounts by Canada, although I'm not sure. But you know what? Not Canada. He's saying okay. How about Australia, Anthony? But remember, we're an independent introducing broker. We have access to Ninja over Zen, Ninja over Rhythmic, CTS, XTrader, OEC, you name it, we can probably get it. So if one outlet doesn't have it or can't support it or you can't do it, then we have other solutions. We have other clearing firms that will accept pretty much everybody except maybe Pakistan, Syria, and Libya or something,
So let's do this.
Australia's okay. I think Australia's okay.
How about an email address for anyone that has questions about Vancar? What's the best way to get in contact?
The best way is to just go to vancar.com and hit contact us. That is the best way. Let us know if you're a client or not. Ask us the question. Obviously, call the number. If you have to have an email address, it's client-services@vancar.com.
Okay, let's turn to some other questions. Here's a little bit more personal one. I don't know if you want to answer this or not, but tell us a story. What's your worst day and how bad was it? How much money And then how would you put that in terms? How would you compare it to your best to your best day? Sorry, my voice is almost gone.
I don't want to get into that, but let's just say my worst day. My worst day was another instance where I just got stubborn and I lost, I don't remember the exact number, maybe $57,000 in about a few minutes in the DAX. Versus my best day that's still okay, but I hardly ever lose that much money. And that was, I don't remember when that was, maybe in 05, 06, something like that. But generally I have 2 days a month where I'm down pretty bad and I can't make it back. And I'm okay with that. I expect those. They're okay. They happen on trend days. They happen on trend days that happen very, very slowly, where you have very shallow pullbacks, and it doesn't look like it wants to go higher, but it keeps doing it, and it looks like it's done, but it keeps going higher and higher and higher. Yeah. And for that, I have multiple rules that keep me out of trouble. 3 strikes and you're out. If I'm fading a trend up and I've taken 3 shorts, the 3rd short, if it's a loss, you're done. I have a daily loss limit, and then on top of that I have a pretty detailed risk plan, and most people don't do this, and you have to do this at some point. That detail, okay, if I'm down 50% of my daily loss limit, let's call it $1,000, what do? I have to cut my size by 50%, so now I can't trade as big a size, so I cut it to 50%. At 75%, I cut it by 75%. At some point, I'm trading 1 lots when I hit my daily loss limit. And the idea is, most people say, oh, you have to reverse martingale or whatever, you know, the next great trade is around the corner because you've taken all these crappy trades. I don't believe that, because there's an infinite supply of data. That works in a box of preset prices, but that's not what the market is.
Well, plus there's an emotional component. If you're not at the top of your game, you're more likely to make mistakes.
Exactly. So my goal is to cut back my size to the point where to keep myself in the game, and it's a lot like surfing. I want to keep paddling and to wait for that stream of trades that now get me in the flow. Not get me green, just get me in the flow. If I can take 3-4 setups that are decent, get my targets, then I can quickly raise my size to 50% of a normal unit, and then I have a chance to make it back. The idea is, though, I don't want to crash. I don't want to sit here and add to a trade and lose 50% of my account. I've done that in the past, and it's just terrible.
Okay, so you mentioned 3 pretty important things I want to touch on. Daily loss limit. I also want to ask about daily profit target or a daily goal, and I also want to talk about what is a realistic rate of return. Let's start with that one, please. There's been some discussion on the forum lately, and I know that it varies so widely because, you know, if you've been a successful trader for 10 years, then obviously it's going to be very different. You know, maybe you have more or less the minimum amount of money necessary to trade in your account. But let's say that you're someone that's just barely starting to turn that corner of being consistently profitable. What is a realistic expectation on a rate of return? You know, because I see it, it's all over the place. Some people tell me they need to do, you know, 5,000% a year, and some people are saying, you know, 5% a month. I mean, what do you think?
I cannot answer that question, unfortunately, for compliance purposes without getting into hypotheticals and past performance, and I have to throw a disclaimer on the screen and be able to substantiate my answer, and I just don't want to get into that mess.
Can I ask it a different way? Do you think that most people have completely wrong expectations? And I mean, what? I mean,
I think the answer is contingent on your environment. What are you doing with the leverage that you have, and what kind of environment are you in? Are you just kind of trading on feel, much like you would gamble on, you know, white or black or snake eyes or whatever, or are you basing your setups out of complete patience, leverage that's well used, in other words, not $500 margins, and are looking for base hits and consistency.
Right.
I'll say this. For my prop traders, the goal was 80% return on margin per month. So on $25,000 a margin or $50,000 a margin, I'm looking for $40,000 per month.
Right.
That's after costs, okay? And that was scalping. That's not fair. It's not fair to say that that's what you should expect, because that is an environment like I'm trying to create through the brokerage, where it's structured. Somebody's watching your risk on a best effort basis or whatever, and you're just not flinging stuff at the wall and hoping something sticks because you're in trouble, or you have to make money because you're running out of time, or your wife's giving you trouble or whatever. It can't be that environment. It's under, good conditions, disciplined conditions. The issue is, again, psychology. Even if I gave you a book full of setups for every condition, if your psychology is not in the right spot, if your mind is not in the right spot, you might be the greatest and foremost expert on the market, and you might see others make 200% a month or lose 200% a month, but you're not able to perform the same way because you don't have the right beliefs or the proper beliefs about the market. The fact is, the outcome of the next trade is unknown.
Let's turn to the daily stop and the daily goal. What are your thoughts on this? I think that most people agree you got to have a daily stop, but let's talk about the daily goal. Some people say, hey, if you have an edge, why are you stopping? Other people say, well, the more that you trade, the further into the day, the more likely you're going to be mentally exhausted and you start making mistakes. And, there's that old saying that you make it in the morning, you give it back in the afternoon. What do you think?
Right. So it's different for everybody. If let's say you came to me, Mike, and you said, man, I've had my skull cracked by this market over the last month. I don't know what to do. I'm losing my mind. And what should I do here? I would say, all right, cut, if you have a scaling strategy, cut to 2 or 3 contracts, maybe 2, and look to secure your risk. Your risk and just go for base hits. Just look for, a 1.5 of risk for a 2-point target or a 1.5 target, and be patient with your setups, and try to build a positive, what's called emotional capital, like positive psychology, by quitting once you've made, say, 6 points on a day, 4 points on a day, whatever it is. It's almost like a high-end athlete who just tore a ligament. You can't get out there and just run right after surgery. So, exercise a little bit. You're going through physical therapy type of thing. Targets make sense. Otherwise, if you're someone who feels like, if you continue to trade, then chances are what you make in the morning, you lose in a day. Right. You're not recognizing that the market is different. The ES is different at 7 o'clock at night as it is at 3 a.m. when the European market opens, as it is at 9:30 a.m. Eastern when the U.S. market opens, and you're not recognizing that it is not the same after midday, the ES. So it's got different personalities, and your edge is showing up in a particular market. For me, unless something really, really cool sets up, between 11 and 11 Central or midday Eastern to about 3 o'clock, I'm fairly picky. I'll scalp other markets. Right. I'll look for ticks here and there. I don't suggest that.
I think there's a pretty easy answer.
You're not recognizing that something changes.
I think that just do your homework. Basically, go to your trade journal service, or if you use Excel, or if you use some online thing like TraderView or whatever, and run a report that breaks down profitability by hour of day, and it should be pretty clear. I mean, if you're making a bunch of money in the afternoon, then you probably should keep doing that. But if you're losing it,
that's
then
exactly right. That's what I was driving to. Some of our traders ask me that. They're like, God, it's so frustrating. I end up giving my money back at the end of the day, and I kept chasing. So what I do is I download their fills, and I separate the fills, filter out the fills for a certain time of day. And my recommendation is, given the current market conditions, you have to frame it.
Yeah.
Given the current market conditions, given the way you trade, you really have no business trading after 10:30.
Hey, bozo, wake up.
Yeah.
Now, here's the thing. I think that there's this mentality that people, they're trading with house money. And I think that's just a huge mistake, because they're up in the morning, and now all of a sudden it's house money, which I don't believe in at all. And now they're much looser with their rules, because, again, they're playing with house money. And then, of course, before you know it, they gave it all back, or worse, they went negative. I think that...
Yeah, I don't know what house money is, because you know what? If you're able to put money up in the first place, you're ahead of a large number of people that is struggling to do that. It is never house money. You've earned it. You've actually taken. You're still paying a debit probably from all the losses you took to get to the point where you can put up money. It's never house money. Again, the theme you should have heard throughout this thing is, I try to secure my risk. I'm looking for that first scale out that reduces my risk to the point that I can just sit in this trade and let it play my plan out. I'm not going to fidget with it. So if you're trading in a method that does that, then your chances, I think, are much more increased no matter what the market turns into. If you're able to take a trade in areas where you feel like, yes, I can get a 6-tick scale out or something like that, or an 8-tick scale or a 4, or whatever it is, and that secures my risk, then the market goes your way, comes back, takes your stop. What have you lost? Fees, commissions? It's not a big deal. You took a chance, you lost some commissions, no big deal. But if you're someone who's just feeling like, I have to make money today, that's the danger. It's like drunk driving. You know you're doing it, but you don't know how screwed up your mind is, and you think you can do it, but it doesn't work out in the end, more often than not.
I think that's it's much worse than having a daily goal where you stop, is having some type of a daily requirement where you feel like you're forced to earn a certain number of dollars, and then that just doesn't work. Okay, so Paul has a question, and we're coming close to the end of the webinar. I'm sure that your time is valuable, as is mine, and my voice is almost gone. But Paul has a question. He says that Peter Steidlmayer has recently kind of distanced himself away from market profile, and I've seen his CME talks and stuff, and he's working on this new thing called volume strips. And I've watched that webinar, and man, Pete he's a difficult guy to follow. Have you had a chance to look at that, and do you have any thoughts on this new thing?
Yeah, I have. He did a webinar that I listened to, and I really welcome that, because it's something that I felt very strongly about way back. It just made no sense to me to do these half-hour profiles. It just didn't make any sense. Most people argued, who held on to the traditional market profile method, they would argue that they're one and the same, and I can tell you from my experience and through this market profile chart that actually more often than not, the POC for the traditional market profiles here, but the POC for volumes way up here or down here. They don't align except on balanced days, and even then it's a crapshoot. So I'm glad that he's making that transition. It seems like it took a while. I know that Dalton's talking about volume profiling as well now. I've looked at the volume strips. They're basically the same idea, but he's doing his cap flow software where it's more of a dynamic profile. It's separating this profile into balanced and imbalanced areas and charting it accordingly and trading it accordingly, which is very advanced. Other than that, I haven't dug in much deeper. I just feel good that he's moved to it.
Sure. All right, Bruce has a question. Hey, can you clarify if older VPOCs should be support or resistance once tested. I don't know if I understand, but that's the question.
Again, context is missing here because the VPOC is the most accepted price of that particular day. So the expectation is, depending on where we are, and unfortunately I don't have a direct example right now, if we break through a low volume node up above, for example, we're falling, the market's selling off. If it gets to a low volume node and then fights with it a little bit and then ends up breaking through lower, then the VPOC becomes an area that is a target. Why? Because it was accepted before. You know, in the analogy of a peanut butter jar, if it's normally $2 and it goes to $5, and the market starts falling from 5 to 450 to 4, chances are you'll get a lot more people saying, I still won't eat peanut butter, I'll wait for it to go back to $2. That's when I'll become active and start including it in my diet going forward. And that's what a VPOC is. It's showing you where prior prices were accepted. So whether or not it's support or resistance, you can't look at it as a line on a chart. It has a bigger meaning, and that's really the theme here. Stop simplifying things to the point where you're just looking for a line or a dot or a crossover. Think about what is it trying to do, because the chart that you're looking at here is representing sentiment. It's representing people, and people cannot be condensed into a, you know, two categories: Republican, Democrat, racist, and blah blah blah. You can't categorize it that way. You got to look at the bigger picture.
All right, let's do one final question and then we'll call it a day. Let's just have a little fun. Talk to me about big picture. Talk to me about what happens if Obama is reelected, or if Romney is elected. What happens to the S&P next year? What happens because of QE3, QE4, QE infinity? You know, let's just talk big picture. What are you thinking out there?
So this is the point where I start to piss people off because of my views on politics or whatever.
Well, I mean, really, there are just certain facts, right? There are just facts that say, yeah.
But you know what? They're all the same. They're all the same. Politicians are all the same, mostly. I think that is Mitt Romney going to come in and all of a sudden, you know, we're all rich and we have a bubble in this and that market? I don't think so. I think in the end they're constrained by the same things, and that is the deficit, our ability to sell our money to foreign entities and to retirement plans and pensions and so forth, macro forces overseas, gold inventories and how gold is moving around the world, and what other tangible assets can be exchanged for currency, because that's what's real. You know, do I buy into the idea that Romney, because he ran Bain Capital, except when it didn't do good things, then he wasn't running it? Do I buy into the idea that just because he did that, he's going to be better for business, better for the markets, better for the economy? Not for a second. Do I buy the idea that if Obama has a better budget plan, that Obama is going to do a better job of controlling the deficit, and that the deficit that we have now, 16 trillion, was the result of, you know, the bad things that Bush did, or whatever your belief system is? I don't buy all that. The fact is, the details are not being discussed because they are above and beyond what politicians believe us Americans to be capable of understanding. It's a lot like sitting in front of a saint or a guru and saying, you know, describe God to me. The answer they'll tell you is, oh my God, you know, it's too much to bear. You're just a human being. You know, and that's the fact. The fact is, we have an incredible deficit. We enjoy the power that we gained through, you know, World War II or whatever, our pricing power in the dollar to keep selling it. But the fact is, you know, we still have enormous debt that has to be paid by somebody, unless we continue to depreciate our dollar. You know, people sit here and tell me at dinner discussions that, hey, you should be happy. The Dow is back at, near 14,000. Not really.
Right.
It doesn't make a difference to me, because if I plotted the Dow in terms of the price of crude oil, or better, in the price of gold,
right,
it hasn't gone anywhere. And the 2.2 or 2.1% inflation, I'm not seeing it. I'm seeing 7-8% probably. So, politicians do make a difference in that they introduce policy that affects our economics and our lives and the wars we go to or whatever. But there are some real fundamental issues that I see with our attitude towards our partners and our enemies and so forth. I think the U.S. can do a lot better. I think Europe can do a lot better. And I don't believe in either party. I'm not a partisan person. I just believe that these politicians will have to, by the nature of our system here or in Germany or in England, have to tell us what we like to hear in order to get our vote.
Sure.
But ultimately, what difference will it make to the markets? If I was a hedge fund manager, am I going to sit and cash until the election happens so that I can take a position? Probably not.
Well, let me ask a broad question. The ES is basically, let's call it 1,400. What's next? 1,800 or 1,000?
I think the overall, as long as we continue to deflate the dollar, then there continues to be a good chance that we continue higher. I mean, it's just a reflection, right? This is just a reflection of our currency. Again, plot any of these indices against the dollar index or against gold, and it'll show you a true picture. I think the overall skew of the market's always going to be upwards. So, we have forces and institutions in place whose job is to make sure it keeps going up, and it does. I don't have the perma-bear view on things. But to be honest, I'm overstepping my area of expertise.
Oh, this is always in good fun. And
I look at yesterday, today, and maybe last week, but that's about it.
I always say there's a lot more money to be made on the upside than the downside. I mean, there's going to be a reckoning. It's going to happen. But until it does, I mean, the government's job basically is to make the S&P go as high as possible. That's what it's most interested in right now.
That's right. And the way you do that is you make the dollar cheap so that we don't have to pay as much on our debt, and our product is cheaper to sell overseas. And you convince the people that inflation's at 2%.
Yeah, I think if you're going to be perma anything, it's much better to be perma bull.
Perma long,
and just prepare yourself. Diversify as much as you can, just in case that you're, that day of reckoning comes. Now, let me ask you about QE stuff real quick, and then we're going to go. Bernanke, is he staying? Is he going? And if he does go, do you think we're going to see a dramatic shift in QE policy?
I believe he stays. Who's going to replace him? I mean, that's a position that has just incredible amount of pressure. Not a huge fan of Bernanke, but then I don't think I'd be a fan of anybody in that position. After all, the Fed is a private bank, and it answers to other banks, and so to me, it's a more of a Ron Paul kind of perspective on that. I don't think he's going anywhere. I don't see anything happening there. I really don't.
I mean, let's say that Romney were to get in. I think that he's on the record. Of course, it may have changed, but basically he wants to stop, all the printing of money and so forth. Let's just say no matter what the catalyst.
He says that.
Yeah,
he says he wants to. But yeah, there's a difference.
Let's say that no matter what the catalyst, if it were to become policy to stop QE, what do you think that there's going to just be, we just won't call it QE anymore, we'll call it something else, but it's the same thing?
It'll be Operation Shout, because we already have Operation Twist.
Yeah.
It'll be twist and shout.
Yeah.
And then what they'll do is they'll fidget with the front end of the curve or the middle part of the curve or some such junk. They'll do some mathematics on their balance.
You can't stop. You just basically you just can't stop it at this point.
The market's no longer reacting to earnings like it used to when I was trading, when I first started trading. I mean, earnings week was huge. Now what's huge is FOMC and any news that has to do with QE. To me, the market is addicted, just like a person is addicted to heroin. They're addicted to central banks, and it's not going to go away. It's a tremendous amount of power handed over to these central banks. And look at what's happening in Europe. You know, markets shoot up or down because Draghi says something, Merkel says something, but it doesn't really go anywhere because some major company, you know, announced blowout earnings. It just shoots up and comes right back. That's not what we're interested in right now. Overall, the big picture, though, to answer your original question, I see Japan kind of economy. I see a long, drawn out,
scary,
sideways, low inflation, maybe deflationary, low interest rate environment. Where we are now is not a good place to be. The market does not operate normally, and it doesn't operate well without an interest spread. We have to have an interest spread, and you don't have an interest spread at 0%, and that's the bottom line. So we're looking at a very long-term kind of chug along kind of economy is the likely, that's the scenario I'd bet on the most.
Right.
And as traders, we're lucky because that's the area you want to be in.
Right. Well, I had a good laugh, you know, like a month ago or a few weeks ago, whatever it was, when we started all these earnings, and you know, Tyler off of Zero Hedge, he made a post on or tweeted something that really made me laugh. He basically said, "Man, we just need a few more big earnings misses, and we're going to hit an all-time high on the ES." It's just you know, such a big disconnect between you know, reality and it's just.
That's right. You're trading an index that is more tied to Fed policy than it is to the underlying stock, because the sentiment of the market is based on pricing what comes into the future, and what comes into the future is a function of how much money we're willing to print so that consumers can consume and prices can, you know, reflect that. You know, I don't see that changing, and it'd be very, very hard to make that any different. So that's you know, where we are, where Japan was 20 years ago, and Japan is still struggling with this environment that they've created of 0%. And that's what we have.
All right, man. So thank you very much for another marathon Q&A. I think that people are going to really appreciate this one, as they have all your others.
Sure. I invite anyone to jump into, if you have questions, and I know a lot of them went by, and I tried to answer a few. If you have questions that you really feel like you're struggling with, I'm very happy when I can. Will answer. Just go to FuturesTrader71.com and hit the contact button and shoot me your email. If I don't answer it tomorrow or next week, I will eventually get to it. So if there's something that you're struggling with or want to know and I haven't answered, just shoot me an email. It doesn't create a contract between us. You don't have to do anything for me, and I don't have to do anything for you, but I am going to try to help you.
Right. All right, man. Thank you very much, man. And if there's anybody out there that doesn't know already, they should be following you on Twitter. It's FuturesTrader71. He has some really good advice on a daily basis. It's definitely worth following. And I'll post the recording for this webinar sometime tomorrow. I'll send the link to FT, and he can send it out to his guys once it's done. All right, man. Thank you very much.
Thanks for having me on. Have a great one.
You
Get
too.
better. Take care.
Thank
Bye.
you. Bye.